there has been this overwhelming attention, is what I'll say, to the whole like velocity banking strategy and movement, using a HELOC, using a personal line of credit, using business lines of credit. And there's also been a movement for infinite banking, which today's not going to be on that. That's another, we'll do it another day. Using the cash value of a life insurance product, almost like a HELOC, right? It's like an equity line of credit for your life, which is very strategic and can be very useful. I do it with clients all the time. The infinite banking movement is real. It is huge. It is happening. And so is the velocity banking movement. Now, here's the truth. Many people will benefit from doing both and even doing both simultaneously. Like, it's a good strategy. I want to focus today on the velocity banking type of strategy and teach a little bit on the math. So that's what I wanted to do a little bit today with you guys. All right. So this whole velocity banking movement, what does that even mean? Right. Please know, like, the history of Money Max Account and United Financial Freedom. We've been teaching this strategy, I'll say corporately, but back in the day, like when we launched this initial Money Merge account, is what it was called, not Money Max Account, Money Merge account. And the reason why is because we actually taught people how to utilize a home equity line of credit as a checking account to eliminate interest and fast forward your debts on all your other debts, and using it the right way, like a checking account, which I'll get into. Okay, and why would you want to do that? I'll get into that. But I bring that up is because we're the company that actually brought velocity banking to America in a big way. I'm not going to say we brought it to America, because there was other people, other companies that taught it as well. But we are the company back in 2004 when we started the initiative that brought it to the masses, teaching the home equity line of credit strategy, not other people. So we brought this to America. We won awards for this strategy. The Ernst & Young Award as being the biggest one, okay? Inside the Money Max account, if they have a home equity line of credit, a personal line of credit, a business line of credit, you can set it as the offset account, okay? Even the all-in-one loan or the first lien HELOC, right? You can do that. It does work and can be quite powerful. It's not right for everybody, and it doesn't always make the situation better. Like, you have to have good, solid cash flow for it to make sense. But it is awesome and can work really, really well. And what I want to do is talk about the execution of this, the math of it, and then you'll see why. Okay? So, first of all, what does this even mean? Before I show anything more on the screen, what a client would be doing is opening up to some great resources. So, home equity line of credit. You can open up a business line of credit. You can open a personal line of credit. And why is that important? Well, here it is in a nutshell, guys. If used the right way, you notice how I said if used the right way? The way interest is mathematically calculated on a line of credit is totally different than the way interest is calculated on a closed-ended fixed loan schedule like an amortized mortgage. But even, personal loans, car loans, etc. The math is different. And so when you understand that, we are so conditioned as a society. Who do you think controls that? The banking system and Wall Street. Okay? And we are conditioned to focus on what's my rate and what's my payment. What's my rate and what's my payment. because they're so conditioned to focus on that they feel like, oh, that great rate on that mortgage, it's like free money. It is not like free money, and we can prove that every day of the week. The way a loan structure is, especially in the first 5, 6, 7, 8 years of that loan, it is not what you think it is. It is not what you feel like it should be. And when you look at the math, and here's what I'm going to say, guys. When you break down a loan, especially an amortized loan, if it actually stayed in that very loan for 30 years, as they're getting further along in the loan, the more is going to principal, less is going to interest. So, 10, 15 years from now, if they actually stayed in that mortgage, it's not all that bad for them. But when you look at the math, if they actually stay in the loan 30 years, and you notice I didn't say stay in the house, I said stay in the loan 30 years, the math is not all that horrible once they get to that point, right? Like 15, 16 years later, 20 years later. Here's the biggest problem. Do me guys a favor. Who has either refinanced or moved in the last 10 years? That's the problem. If they're refinancing, and it's a lot of us, okay? Me too. If they're refinancing or moving within a 5, 6, 7, 8, 9, 10 years, like in the last 10 years, the math says, well, wait a second, you just started that cycle of that math, front-loaded interest all over again. So I don't care if it's a 3% loan and it's like free money, because you never actually get to that where it's actually what they're saying it's going to be, because you're starting that cycle all over again. So in a 10-year period, you gave $100,000 of payments, and 60,000, 70,000, 80,000 went to interest. And then you start it from the beginning and do it again. How is that ever going to be 3, 4, 5, 6%? It's not if you're starting it over and over and over and over. The math is clear, and we don't think about it that way because we are conditioned to do things other ways, to focus on rate and payment, rate and payment, rate and payment. What velocity banking teaches in a really solid way is it's not about the interest rate. And even infinite banking, Nelson Nash and all that, it's not about the rate. It is about the volume of interest that you're actually paying compared to the principal that you've actually paid. Because if you're starting that cycle all over again, the volume of interest is crushing you. And I want you to flip the switch first. If that was an investment, and I said, I need you to give me $100,000 over the next 10 years for your investment, I'm gonna get you a great return. Oh, but I forgot to tell you, I'm gonna take 70,000 of it as my fee. But don't worry, 30 grand of it's gonna go into the investment. I mean, unless you got a massive return on that 30 grand, would you ever be okay with giving me 70 grand as the fee for finding the investment for you out of that 100 grand? You wouldn't. So why in the world are you okay with that with your debt? Because you got a great rate and a great payment. Makes you think, doesn't it? Again, if you actually stayed in that loan for 30 years, there's a decent argument. No one ever does, and no one ever will. I shouldn't say ever. There's going to be people that do, but most people don't. And if you know that you're probably going to start that cycle over again, then the rate is irrelevant. The rate is irrelevant. It is structured as a 30-year amortized loan, or a 15-year amortized loan if you do a 15, or 20, or 25, whatever you do. Goodness, there's people doing 40, 50 years now, right? So in Japan, they do 99-year mortgages. What? Where the family signs up for the loan. That's what they do in Japan. But think about it. Rate and payment is so driving people that, okay, if they can make the rate lower and they can make the payment lower, that's attractive. So, velocity banking allows clients to eliminate a ton of interest because the way interest is mathematically calculated is different. The way the interest affects the loans and all that is different. The way interest is calculated on a revolving line of credit is based on the average daily balance. Remember that. Average daily balance. So if that's the case, I'm going to teach you some strategies, and the Money Max account just makes it all amazing if they use velocity banking. Okay, so let's go into this real quick. The way velocity banking works, in most cases, you have a HELOC. Now, sometimes it's a first position, first lien HELOC. Sometimes it's a second position HELOC, right? But you have a HELOC. And in this HELOC structure, and by the way, this can also be done with a personal line of credit. I mentioned that already, or a business line of credit. You can do it that way too. And the Money Max account allows you to click the personal line of credit as the offset account. It's underneath the preferences. But the way it works is you're using the line of credit like a checking account. So what does that mean? All your income, not some of your income, all your income goes in, all your expenses get paid out. All your income goes in, all your expenses get paid out. All your income goes in, all your expenses get paid out. We get commission. It direct deposits into our checking account immediately. Send it as a payment to the HELOC. But yet, all your expenses are getting paid out also. So why is that advantageous? Because when you do that, right, it is literally changing the interest immediately on that line of credit, right? And I'll explain that in a second here. Many times, it even helps cash flow a ton. Give you an example. I have a line of credit that I'm using. I pay my expenses out of it, $5,000. Slowly over time, over the course of the month, I'm spending money out of it to pay my expenses. But I'm also putting all my income into it. Here's a trick question. If you're doing that, this may be an aha moment for some people. Do you ever have a payment due on the line of credit itself? You do not have a minimum payment due. You don't. And the reason why is those monies going in to the line of credit, your line of credit is not an account. It is a line of credit. It's not a bank account. It's not a checking account. Now, some have sweep accounts attached to it, and I get that, but the line of credit itself is not a checking account. So any money going into it has to be categorized as a payment to it. So therefore, if you get paid biweekly, well, every 2 weeks it's a payment. So you've already satisfied the payment. Now, is there interest that's accrued? Of course there is. And the interest is based on what's known as the average daily balance. So let's do that math again. If money goes in, money comes out. Money goes in, money comes out. Money goes in, money comes out. I put $10,000 in. I take $10,000 out. What's my average daily balance? Now, I know technically that's not how it works because it's 31 days, but just from a big picture, 10,000 in, 10,000 out, 10,000 in, 10,000 out. Even though I use the bank's money all month, my average daily balance, I'll say, for training purposes, is almost zero. And it all depends on the timing of when you took the money out and when you put the money in. But the average daily balance is based on the billing cycle of that month. And that is what you're charged interest on. So, from a pure math perspective, could you see how you could time it well that even though you're using the line of credit, you're getting charged almost no interest to do that? All right, now let's take it a step further. I charge all my credit card, all my expenses on a separate credit card. Yet all my income goes into this line of credit all month. And then at the end of the month, on the 30th day, is when I use the line of credit to pay off that credit card. So you use the money interest-free on the credit card for 30 days. That's how credit cards work. And then the line of credit was used to pay off the credit card on the last day of the month. So your average daily balance was only going down, 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 down for 29 days. And then on the 30th day, it went up. The average daily balance is based on the 30 days in the month or 31 days in the month, the billing cycle. Would you agree that if the balance only went up one day that month and was going down the rest of the months, that the average daily balance throughout the month is much lower than the money you actually used? Timing of that needs to be perfect to maximize it. What perfects timing, everybody? The Money Max account. Okay? So why is that advantageous? With the Money Max account, we know execution, and I'll talk about that later. Okay? But there's different ways of doing it. It is when you have a first lien HELOC, a lot of you know what that is, I think, okay? But a lot of times a first lien HELOC like replaces your first mortgage. So you have a $300,000 mortgage, you get a first lien HELOC for 300 grand to pay it off, and now you're literally using it just like you would your checking account. Many times they have a sweep account built into it. So what that is a checking account attached to it, so that money goes in, money goes out, money goes in, money goes out. The average daily balance, right? It is a giant, huge, both checking account and credit line attached together. It acts exactly like that. And as you're spending money and making money, spending money and making money, if you make more than you spend, every month your balance on that line of credit is going down. And it's extremely advantageous. It's not for everybody to do a first lien HELOC, but it can be very, very useful. Second way, okay, is a second position HELOC. And so here's the math of your mortgage. You guys have seen this. You have probably looked at it before, but have you really broken it down, like taken the time to do it? This is a $370,000 mortgage at 3%, which I know nowadays we get 6, 7, 8%, right? But this is just basing it on 3% because a lot of clients are staying in that loan because they love that 3%. If you look at the math, this is just their principal and interest, $1,560, and almost 1,000 of it's going to interest in that first month. Right? We know that. That's what I meant before by it's the interest volume, not the interest rate. Over 6 months' time, right? Almost $6,000, is going to interest. That's not 3%, right? It's crazy, okay? So this client is using a line of credit, is wanting to do velocity banking, and is using their second lien HELOC, or even a personal line of credit or a business line of credit that they have, and it's a 10% interest. The Money Max account maximizes that, but the way they would do velocity banking, because that's what I'm teaching on, is all the money is going into the line of credit and pay all their expenses out. Even if they use a credit card to pay it and then pay it off at the end of the month like I taught, money in, money out, money in, money out, money in, money out. And then all of a sudden, at the right time, if they're using the Money Max account especially, it says, you know what? We're going to borrow, we're going to take $3,199 from the line of credit, and we're going to send it over as an extra principal payment to the mortgage. Now, here's a little training. That one money transfer, that one money move, did they go into more debt at that moment? Tammy says no. Does anybody say yes? They did not go into more debt.
Right.
The balance on their mortgage went down by $31.99 because it's a principal payment. The balance on their line of credit over here went up $31.99. Their total debt amount stayed exactly the same. Why in the world would they do that? Well, I just taught that the interest on a revolving line of credit, in this case it's the HELOC, the way it's calculated is differently than the mortgage. Did their lifestyle change from taking $31.99 from this place over here and sending it to this mortgage over here? No, their lifestyle didn't change at all. They're still making, $5,000 a month, still spending $5,400, $4,100, whatever, right? Their lifestyle didn't change. It was just a move. But why is this move so important to them? Well, when you look at just the math of it, it absolutely makes sense to do this little chunk. And the reason why is this. They are going to spend, there it is. They're going to spend $320 in interest if they never change the balance on that line of credit. It breaks down to be about $26 a month in interest. So they're going to spend $320 for a year. Okay, that's a year. So it's $26 this first month. But if they never paid off that HELOC, if they stopped putting their income in, basically, okay, because they're doing velocity banking, so they never paid it down, they're spending $320 for the first 12 months. Again, if they didn't put their income into it, which is not what they're doing, but this is just worst case for them, right? And that $31.99 took off this month of interest, this month of interest, this month, and this month. See, a lot of people don't fully understand when you apply a principal payment to the mortgage itself. Well, this could be a personal loan, a car loan, whatever. But when you apply that loan, that extra principal, a lot of people just think, oh, well, yeah, I mean, it took the time off the back end, and now I have 5 months less in mortgage payments. That is true. The time came off the back end. But they jumped ahead in the loan schedule. They skipped October's payment, November's payment. They jumped ahead. It didn't come off the back end as far as the interest goes. It jumped ahead in the loan schedule. Because the way interest works on an amortized loan, it's based on what is the principal balance that month. So it jumps ahead in the loan schedule. That is so important to understand. And when you do understand that, that is an aha moment. Because here's the truth. Would anybody on this not trade $26 of interest that you have to pay on this line of credit over here to save 5 months of mortgage payments and $4,600 of interest gone? Would you make that trade? Put your business hat on, you would. The question is, from a math perspective, does it make sense? Well, let's do the math. You saved $4,600 in interest. You paid 26. So how many months does it take for $26 of interest? Let's pretend you didn't use the line of credit anymore like a checking account. So even though if you did, the average daily balance would be less every month, which means next month the interest would be $23, not 26. Okay, but that being said, how many months does it take for $26 to equal 4,600? 176 months. How many years is that? 176 months. So hear me on this. Why velocity banking can be powerful. you would have to keep that $31.99 balance, $3,199 balance on the line of credit for 14 years before it didn't make sense to send that $31.99 out of it to the mortgage. Meanwhile, the average client's going to be debt-free in 5 to 7 years anyway, maybe 10, maybe 12, right? So for it not to make sense, the amount of interest on the line of credit has to equal the amount of interest that you saved on the mortgage, right? 14 years. There is no reason that that is not a good financial movement right there. The question is, well, how many times do you do that? And the question is, how often do you do that? And if you're using your line of credit, like velocity banking, you're going to do that more than one time. There's going to be times where you chunk it over and then chunk it over. And it's because the math makes sense to do that. The Money Max account just absolutely perfects it. Okay? And for those that don't know, like when you go into the Money Max account, under settings, you click on preferences. Okay? If you have a line of credit, a home equity line of credit, or even a personal line of credit, business line of credit, etc., it will recognize it as line of credit. And if you have, just so you know, I'm not showing this, where it says line of credit over here, because you go to, let me go back again. You click settings. Oops. You click settings, you click preferences, right? And then after you click preferences on the left-hand side, you have system settings right there. And then it's under banking strategy. It says line of credit. You notice it took off about 4 months here, 11.6, 11.9, right? Which is neat. If you have a HELOC and you also have a personal line of credit in the system, it's going to say, well, which one do you want to use for this strategy? And you pick personal line of credit, HELOC, whatever, okay? And the moment you do that, the action plan completely changes. If you notice, John's income is no longer going into his checking account. It's going into his HELOC. If you notice, the funds transfers to pay off that Visa and to pay towards that mortgage is coming from the HELOC. Because it's recognizing it as the way to maximize their efficiency and to pay off debt and to eliminate the interest the most effective way. And his income is going in, right? And so it is really, really efficient. Okay, and then this is another teaching another day. But the truth is, it is based on the average daily balance can be manipulated with the right timing and the right cash flow to eliminate the interest on other debts way more effectively. Now, granted, could they pay extra principal? Can we do it from checking and savings? Of course, like we know that there are times that, I mean, maybe there's not really much of a difference, so it doesn't make sense all the time. But it really does make sense a lot of the time if they have access to that line of credit and a way to use it effectively. I would hate clients doing it on their own because they get themselves in trouble. That's why the Money Max account maximizes it completely for them, for timing and everything. All right. So, any questions, comments, concerns?